Well, good morning and good afternoon, everyone. I'm Elliot Kallen. I'm the CEO of Prosperity Financial Group. I want to welcome you to another exciting episode of Meet the Expert. And I'm saying that because when we talk to an economist and people that run money on the institutional level, timing is so important. You can't invest in 2023 the way you just did in 2021. Times are different. So to reach me, it's Elliot at ELLIOT at prosperityfinancialgroup.com. 925-314-8503 or www.prosperityfinancialgroup.com. And this is another episode. I think we're in our 50s now for a number of episodes. And we just found out recently that we are in our top 2.5% of all financial podcasts globally. So how's that for an achievement, everybody? Thanks to you for listening to this. All right. So we're going to have today Bob DeRochie. I think I pronounced DeRochie. That's great. Confusing name, a little bit of French from New York in there. That's great. He is Senior Vice President, Fixed Income Specialist, lives in Tennessee, from New York, with First Trust. First Trust is a strategic partner of ours. They run institutional money for companies like myself, Prosperity Financial Group, and they are a bit beyond $200 billion. Just staggering numbers. We start talking about $200 billion. As they used to say in the old days, a billion here and a billionaire, and sooner or later we're talking about real money. So they are at 200 billion. So I'm going to ask Bob a few questions here about the economy and income, fixed income, meaning primarily bonds, but not necessarily, but products that yield money to you, dividends, interest, and yield. They do those things. So if you need to receive some income or you want to reinvest it, these are the type of products we're talking about. So let me welcome Bob. Welcome, Bob.
Thank you. Thanks for having me.
Thanks for being here. Much appreciated. So, you know, it's every day seems like the news is dropping all around us. We were in a recession. No, we weren't. We're going into one of the first half of this year. Now we're not. It's the second half. It's a hard landing. It's a soft landing. The economy is unsure what to do. Big jobs report. What's going on with the recession and the economy here? And what can we as a consumer expect to have happen in front of us?
Well, you know, it's been interesting. I mean, this has been going on for about a year and a half, where you hear all these investors and money managers and economists around the country saying, you know, get ready. We're gonna have some hard times here because the Fed's raising rates. You know, you think about that in the Fed of what they're doing. You know, yes, they've been raising rates, and the reason is due to inflation, because inflation got out of control here with all the money we put into the system due to COVID. And when I think about, you know, where we are today, you know, rates were at 0, now they're at 4. And I get this question a lot. Well, rates are really high. And when I think about where rates are today, going back in my almost 40 years of doing this, to have interest rates back at 4 is more like a neutral to me. I don't think rates are overly expensive. I don't think they're high based on historical standards going back to the 70s. But if you're young and you haven't been in the business as long as we have, some of us like me, you know, you think rates are high because we've been in a 0 rate environment for over 20 years. You know, rates have been artificially low. And now that rates are going up, there's this consensus it's going to destroy the economy. We're going to have a lot of pressure. We're going to go into a recession. And the answer is yes, we're going to go into a recession. But the question really becomes when and how bad is it going to get? And I think that's what the market's trying to figure out right now in the economy. How bad is this recession going to be? And that's what Powell's trying to think about, of what we need to do to make sure things don't get too bad, like an 08 event, but yet we address inflation and all the things that come with it.
Okay, so you leading right into my next question, and that's going to be about inflation. We're talking about to Bob DeRochie of First Trust, who's a bond and fixed income specialist there. Inflation was basically nothing for the longest time. We all got spoiled. You know, I remember the 70s because I was driving in the 70s. Remember my dad whining that gas finally hit 50 cents a gallon. Who's going to be able to afford that? His house that he bought for $20,000 was going up every year. The cost of goods was silly. And we seem to have entered that, although it's softening just a bit. We know that gas, at least I'm in California, and some of the people listening are from California, that gas is up $1.50 a gallon from a year and a half ago. Just that. We know eggs have gone up 400% or whatever. They're maybe the worst. We know there's supply shortages in there, but still inflation and wages, which is high pressure on inflation, is going up. What can we as a consumer do? What can we feel? What's happening in the forecast of inflation now?
Yeah, I mean, you think about, 2 years ago when the Fed was out there saying, don't worry, this is transitory. This inflation's not going to be a problem. It was running at 1 to 2%. And everything's going to be fine. And then all of a sudden COVID hits. We have all these shortages, like you said. And all of a sudden we pump in $5 trillion into the economy by giving all this stimulus and all this free money to people. Well, think about it. It's economics 101, supply demand. If you give me a lot more money, I have a lot more money to spend. I'm willing to pay more for a product. And then the supply chains basically get affected because we can't manufacture as much. And all of a sudden you got this impact of inflation starting to pick up. And that's what we saw. And inflation got up to about 9%. And right now we're at 6.5%. And the market is trying to figure out, where is the plane going to land on inflation? The plane right now is at 30,000 feet and it's cruising along and it's starting to go lower, inflation. And so the plane's going lower. But the Fed is saying, hey, our target is 2 and we're at 6.5. And they keep raising rates, but inflation is not going down as fast as people expect because of what you said. There's other factors that are driving this. And that is the $1 million question of what we need to think about going forward is, where is inflation going to? And we think it's going to be higher for longer. That's our view. There's other people out there that think by the end of this year, inflation is going to be back down to 2 to 3%. And that's the battle that's going on in the markets right now. And they're trying to figure out, there's this big battle trying to figure out where things are going as we look forward. And we just think it's going to be elevated higher than longer. And certainly part of it is energy, like you said, oil and gas, China's reopening their economy. We expect them to pick up demand and consume more energy in their economies. We're expecting to replace the strategic reserve of 200 million barrels. We got to put that oil back. That's going to put elevated prices in energy. And that's something that you got to think about as a consumer. Gas, we're going to the driving season here in a couple months. People are going to start traveling again. The winters, they don't go as much. All of these factors, I think, are going to have an impact on energy. We like energy right now as an area to invest. And that's going to, remember, everything's made with energy. Everything. Our clothes, our office, anything in your home, you need energy to make. And that is going to be the driver here as we go forward. It's going to be one of the components. Certainly wages is another one. We think wages are going to continue to go up because of inflation. And then the third part of the inflation thing that you got to think about is rent. You think about housing prices, they've gone up so much around the country. Yes, they're coming down here a little bit, but rent has not caught up to that. And rent makes up 30% of the index of inflation. So all of these factors we think are going to have an impact going forward. And you got to think about that when you invest.
Well, I'm going to get back to the commodity and energy story if I could in a moment. Let me ask you a question about the Federal Reserve. And for those listening here, meet the expert at prosperityfinancialgroup.com. For those who are listening, when we talk about the Fed, we're talking about the Federal Reserve Board run by Jerome Powell, is just based outside of or in DC, or their board. I think the board is in Delaware, aren't they?
I think so. Yeah.
Yeah, and so they make policy on interest rates that they charge to banks, which convert to us and what we're paying, not the 18 and 21 and 24% on credit cards, but on things like short consumer loans and business lines of debt and automobile loans and things like that they're affected by. So they've been raising interest rates by what was 0.75%, which is abnormally high. That used to be 3 raises in the old days of 25. Now it's 1 of 75. And then they went to 50 basis points, which is 2 times 25. Again, usually things that we're not used to. And now it's back to 25. What's the forecast for them based on what you just said, with energy still going up and wages still going up? And we're obviously not in a recession if those two things are happening. We could be entering stagflation, and maybe you could touch on what that means in English. But is the Fed going to make our life a lot harder this year?
I think there's more hikes to come. I think Powell made that very clear yesterday or the other day when he did his interview, and they raised rates 25 basis points. I mean, you think about how many times in 25 basis point increments, how many times have they raised? It's been 18 hikes. That's how many they raised if you just look at 25 basis point hikes from where we started. And Powell made it clear, like, we got more work to do. Now we're going to slow down the pace of hikes, meaning they're going to do 25 basis points, but we still think they're going higher. You know, the target right now for the Fed is 5.25. And that's based upon the data they had in front of them. But, you know, today some data came out that was a big surprise to the market. It was the job number, and a lot more jobs were created than expected. Now, is that going to make things better? No. I think it gives more challenges to the Fed that they're going to have to continue to raise rates. So, you know, right now we're still thinking 5.25 is where we're going to see the Fed raise short-term rates. And you can look at it one of two ways. Is that a good thing or a bad thing? You know, in one way, it's not good if you've got to borrow money to buy a house or to buy a car. Your interest costs are going up. But it's also a good thing if you're an investor. So if you want to invest money to get a 5.25% rate, say sometime this year on an investment, that's pretty attractive versus where we were a year and a half ago when rates were at 50 basis points. So it really depends on how you look at it through your lens of how this is going to have an impact on you as an individual or as an investor. But you got to know where to go. That's the key.
Okay, so speaking of where to go, let's talk about where to go, because that people don't understand that in the world of bond investing, and I know that's your world, and you could run circles around me with your eyes closed. I get that, but I have to be the prognosticator for my clients. And so some time ago, you and I had a conversation in Austin, Texas, and you said, buy ultra short, be short in bonds. So for those that don't understand that, when we talk about short, we're really talking about bonds that mature in 2 years or less. And ultra short, obviously, you're getting a little bit skinnier than that. And then there's medium, and medium is generally 2 to 5 years or so. And then long term, it could be 5 to 10. And of course, T bonds could be 30 on that. So there are ways to go. So we have put our clients on what's called the short end of the curve. And I hate to use that curve because that means so many things to so many people. But yeah, we're staying short, meaning they mature quickly and they're going to be less beaten up by interest rates going up and by inflation. Am I saying that accurately?
Yes.
Am I giving good advice?
You are. Yeah, I think last year for me, you know, at First Trust, my job is to communicate how you want to position fixed income. And I was saying play defense. You want to play defense in that last year market because, you know, depending on what you invested, you could have been down up to 33% if you bought a 30-year treasury. You lost a third of your money. Or if you went in the ultra short, like you were saying, you were maybe up 1%, which is a victory because there's a lot of bonds that are down 10 double digits returns last year. So, you know, to play defense right now is probably prudent. And what I'm thinking about now is it's not all interest rates that you got to think about. You talk about interest rate risk as that risk, rates going higher, it's going to have an impact on the value. But what I'm thinking about for 23 is there's more risk than just that. You got credit risk, you got duration, spread, volatility, liquidity. And now these are all technical terms. I'm not going to get into the details, but just know from a very simplified point of view that there's more risk than just interest rates. And when I think about 23, those are the focuses you got to focus on as an investor. And that's why you need a financial advisor to guide you through these types of markets. You can't do these on your own anymore. It's been easy to make money, but I think it's going to get a lot more challenging and a lot more difficult for investors to navigate these markets. And that's why they need professionals like you to do this. And that's where we come in as well.
Good. And I've got a few questions about that. Let me ask you a question before I get to that.
Yeah,
that's going to be a longer answer, and that's kind of the pinnacle of what we're talking about is give us the future of where we should go. Where's the puck going to be on the ice for us old hockey players out there? But let me ask you first, since so many people in bonds are the most conservative investors in the country, they're buying treasuries, they're buying money markets, they're buying CDs, they're going to us where bonds have had volatility versus CDs that haven't. Banks are suddenly invading much more of the fixed income space. Versus 3 years ago, they were non-existent for the most part. So for what can we do to help out and where should the most conservative people be without buying a 2% CD and locking it up for 2 years or 3%? Where should they be? How do we help them the most there, Bob?
Yeah, I think right now, like, there's corporate bonds out there. There's short-term investments that are yielding over 5.25 right now, with not a lot of risk. And that would be like a 2-year bond, somewhere in that range, maybe a 1.5-year bond. So you're not taking a lot of time risk. You're not taking a lot of credit risk. I mean, you can buy 1-year T-bills right now at 4.70. And they're going to go higher because the Fed is going to continue to raise rates. To go out and buy a 10-year bond right now, I don't think makes sense. Not yet, because there's too many unknown variables that we don't know what's going to happen here in the next 18 months. We don't know where inflation is going to be a year from now. It's like you said, where the puck's going. I have no idea where inflation is going to be. It could be at 2, it could be at 6. And that variable between those two numbers is going to have a different outcome on the bond market. And to take that risk, it's not worth it. It was worth it 10 years ago because the Fed kept lowering rates. It went from 4 to 0, but now it went from 0 to 4. This is a different environment. So to really figure out where the puck's going to go, I say play defense. It's not time to play offense in the bond market yet. There is going to be a point in time where we're going to want to play offense. We're not there yet. Are we closer to playing offense than we were a year ago? You bet. There's no doubt. But we got to wait and see more data before we turn the plug on this.
Okay. And along the same lines, before I ask you the tough questions, along the same lines, we think about playing defense. We're avoiding right now high yield bonds for our clients, mortgage bonds for our clients, and convertible bonds for our clients. Are we doing the right thing?
Yes. Yeah. I mean, because, if we go into this recession, when you go into recession, those 4 pillars of risk I mentioned earlier typically get worse, meaning in high yield bonds, defaults, companies going out of business, like Bed Bath & Beyond announced they're filing bankruptcy. Think about that company, how successful they were for 15, 20 years. They're filing bankruptcy. And that company is no longer going to be selling towels and kitchenware and all that. Those bondholders are going to be losing their investment, not just the equity guys. And as a bondholder, that's what you want to avoid. And why take that risk right now in high yield? It's not worth it yet because we think defaults are going to go higher as we look forward here in the next 2 years.
Great. And we're talking with Bob DeRochie of First Trust, a strategic partner of ours. And they're a Midwest monster for doing a great job with ETFs. And on a personal level, I really enjoy them. So they're a great partner of ours. And Bob, we thank you for coming on, and Andrew for setting this up. Let me go to that last big question, and you touched on it, and that's the future forecast, the crystal ball, 2023 crystal ball. We won't even talk about 2024 at this point. That's way too far away. Let's just stick with this year making money. Nobody wants to have happen in their portfolio what happened last year. People down by 10 to 50%, depending on how far out on the curve of technology they were. So we don't want that. And that level of pain just will become intolerable if it happens again.
Right.
So now where can we do? You mentioned energy. You like energy. You didn't mention commodities other than energy. I would love to hear your opinion on that. And then the equity markets, because our client base is largely involved in equity markets and less involved with fixed income, and sometimes it's blended, but they just want to make money.
Yeah. I mean, that's the goal. We all want to make money. We understand it. And making money, you got to also manage one thing. How much risk are you willing to take to make that money? And that's the key, risk adjusted. And when we think about the equity markets here at First Trust, there are some areas we like. We like value. Think about value. You go to Walmart, you get value there. You're getting better pricing and all that. Well, there's stocks out there that have value versus growth. Growth means the company's just going to grow revenues real quick. And over time, maybe they're losing money now, but in the future, they'll make money. But we like value. We think there's better value in the stock market than it was a year ago because we've seen these big pullbacks. We also like healthcare. We think healthcare stocks is a good defensive way of playing this market. We like biotech. It's another area that we like. We like energy. So some of these sectors that I mentioned is really playing defense within the equity market in those areas, because we do think we're going to go into this recession. And as you go into these recessions, you got to be careful what you own, because some are going to underperform others, just like last year. So that's what we're thinking there on the equity market. I'm not the equity expert. These are my colleagues, and they tell me, and I listen to them because I do what they tell me on that side. And then on the bond side, just to reiterate, I think you should keep your money short, play defense. I mean, is anyone on this call going to be upset if you make 5% in the bond market this year? If that's the outcome, I don't think so. I think most investors would be satisfied making a 5% return. And last year, obviously, no one made that because of what happened. But I think that should be the expectation this year. If you can make 5% without taking a lot of risk, I call that a victory.
Great. Well, this has been great, Bob. I mean, I learned something. The question you did not answer, and can I hold your feet to the fire to answer this last question? And that was the world of commodities. We know energy, you predict, is going to go up, but commodities, sometimes I feel like we're whipsawing our clients up 20%, down 10, up 30, down 5, up 5. It's like watching a heartbeat in action, scaring you to death. Where do you think the commodities world is going to end, other than energy? Just, I mean, if you think traditionally, commodities prices have come down because of pressure with lack of demand. You don't see that, or you do see that?
Well, that's the challenge right now, is if we have demand destruction, commodity prices are going to go lower because there's going to be less demand for building materials or, gold and whatever commodity you're referencing. But when you think about inflation and you think about where we are, we like commodities. We think there's value right now because we've had the pullback. We think it's a better entry point now. But I think the key is if you're going to go into commodities, be patient. It's not going to happen overnight if you're going to invest in that. So that's and energy is part of this trade. But we have strategies that offer commodities, and they're actively managed as well. And we like them. I mean, they've done relatively well. We've had the pullback, like you said. That's why I said I think it's a better entry point now. But if you're going to go in, just go in slow. Don't dive in the pool. Put your toe in the pool. Average in over time. That's what I would say.
All right. Well, Bob, I want to thank you so much. Folks, you've been listening to another episode of Meet the Expert with Bob DeRochie from now Tennessee, originally New York. We won't hold that against him. I'm from Jersey, but that's okay. It's still the land of White Castle and yummy food. And we've been talking about the fixed income market, a challenging market. If you've got more questions, give me a call, 925-314-8503. And you've got my email, and reach out to us. So Bob, thank you very much.
Thank you.
All right. Have a great day, everybody.